the global economy is heading into recession. At least that is the fear after months of warning signs from the engine of global trade, which has spluttered this year. Here we examine some clues that the trend, after 10 years of expansion, could be backwards. While recession chatter endures amid a persistent trade war with China and a further retrenchment in corporate investment, robust signals from other aspects of the U.S. economy, like the labor market, have eased concerns of an imminent downturn. Bloomberg Economics created a model to determine America's recession odds. Right now, the indicator estimates the chance of a U.S. recession at some point in the next year is 26%, down slightly from 27% in early October. That reading is higher than it was a year ago but significantly lower than before the last recession. There are reasons to keep a close eye on the economy, but it's not time to panic, yet. 18 months ago Donald Trump began his America First campaign with a fight over steel dumping. The U.S. president imposed 25% import tariffs on steel against China, the EU, India, Canada and Mexico. Since then the focus has all been on China. Trump blamed Beijing for undercutting U.S. goods with an undervalued currency. As a punishment he imposed import tariffs on a wide range of Chinese goods and has threatened to expand the scope to include computer games consoles, mobile phones and laptops. It's difficult to measure the impact, but most countries report a downturn in trade since the tariffs began to bite. Trump inherited a buoyant economy and then gave it a sugar rush of income tax cuts and corporate giveaways. Stellar growth last year prompted the U.S. Central Bank, the Federal Reserve, to increase interest rates to calm things down. A combination of those higher borrowing costs, the end of the sugar rush and the tariff war with China, which has increased import costs, has hit U.S. industrial production. Figures last week showed the U.S. manufacturing sector in decline for the first time in a decade. Trump has berated the Fed for being slow to cut rates again. Angela Merkel Finance Minister, Olaf Scholz, has raised expectations of a €50 billion boost to the German economy to head off an imminent recession. The economy contracted by a small margin in the second quarter, something about 0.1%, but is expected to suffer a second and larger drop in the third quarter. Most analysts expect Schulze's extra cash will be too little too late to prevent 2 consecutive quarters of negative growth, which is the technical definition of a recession. A turnaround next year largely depends on a recovery in China, where Germany now sells much of its machine tools, industrial equipment and cars. China, more than the U.S., has been the extra gear for the global economy since the 2008 financial crash, but the country is in the throes of a full-blown debt crisis. State industries have borrowed heavily and so have consumers. Banks are weighed down by loans that will never be repaid. Each time Beijing has attempted to rein in excessive consumer and corporate lending, the global economy has wobbled, forcing China policymakers to loosen credit again. Meanwhile, industrial production growth is at a 30-year low at 4.8%. Beijing wants the economy to become more self-contained with a shift from manufacturing to services, but it's a long haul. The uncertainty surrounding Britain's future and whether it remains inside the world's largest trading bloc or swims alone has already damaged investment and GDP growth. If the UK leaves the European Union without a deal, most economists believe the damage will be severe. A string of countries are currently in recession or have recently suffered a contraction. Iran faces a blockade by the U.S. and is unable to sell its oil or access the financial markets easily. Argentina is weighed down by enormous debts, and Venezuela, despite holding the world's largest oil reserves, is in political and economic crisis. International investors don't worry much about these countries, which have over the years been financially ring-fenced, but South Africa and Turkey pose a greater problem. They are more integrated into regional and international markets, which means a debt default would have a far greater impact. Signs from the international money markets are mixed. Stock markets in the US and Germany remain at historically high levels, but bond markets are more jittery. Investors who lend money to the US government via the bond market have sold their short-term loans in droves in expectation of an imminent recession, much as they did before the 2008 financial crash. The bond market never lies, especially about the path of the U.S. economy, say many analysts, fueling even more speculation that U.S. economy could be in dire trouble as early as next year. The savior could be the Fed, which might cut interest rates back toward zero, allowing indebted companies and households to breathe a sigh of relief. Employment figures provided by the Bureau of Labor Statistics provide a close to real-time snapshot of the economy. A decline in payrolls or hours worked, especially for more than a month or two in a row, can signal a slowdown in employment. An increase in unemployment claims is also troubling for similar reasons. Keep in mind that there may be fluctuations isolated to some sectors of the economy, and that these don't reflect as strongly on the overall picture of economic health. The unemployment rate stands at 3.7%, near historical lows, and is indicative of a robust employment market. Housing prices, construction rates and supply are another set of indicators to watch. Generally speaking, when times are good, housing demand is high and prices rise. When demand begins to contract, fewer new homes get built, or existing homes sold. Both of these can indicate a slowdown is forthcoming. However, existing home prices and sales have each continued to increase in recent months. The Consumer Confidence Index, which details consumer attitudes and buying intentions, is also important to monitor. Whether consumers feel confident about spending in the present or future trajectory of the economy tells us a great deal about where our fortunes are headed. At present, this index continues to demonstrate persistently positive consumer attitudes regarding the economy. You can also take a look at manufacturing numbers and business sentiment. The Institute of Supply Management famous ISM gauge is a measure of the overall health of the manufacturing industry via its PMI index. It should read below 50, as anything under that represents a contractionary environment. Like consumer confidence, if business sentiment is low, it can also foretell a slowdown to come. The most recent PMI figures came in at 49.1, signaling a somewhat contractionary business sentiment and environment. Gross domestic product, or GDP, is the best measure of an overall economy health. Technically, we enter a recession when we have 2 consecutive quarters of negative GDP growth. For now, the first and second quarters of 2019 featured 3.1% and 2% GDP growth, respectively, both indicative of a continued, moderate expansion. Thus, a decline in the growth rate, while concerning, is not actually indicative of a recession. Still, slowing GDP numbers mean we could slip into a negative growth situation, and eventually, a recession, so GDP is still the gold standard by which recessions are truly measured. Finally, the Conference Board Leading Economic Index provides a more comprehensive view of the economy, via a composite score derived from a variety of economic indices. It is a handy gauge of where most major indicators are pointing. The most recent reading signaled expectation for moderate growth in the second half of 2019. While no single gauge can provide a complete impression of the economic outlook, the lay is often used as shorthand for economic expectations.